Yeah, here we go. Can you see my screen, Zach?
Yeah, you're good.
So, some of the key findings in the Dalbar study was that the average equity fund investor underperformed the market. And that is the average equity investor earned 5.5% less than the S&P 500 in 2023, which was the third largest investor gap in the last 10 years. This study was conducted in April of last year, so it's about 1 year old now, but it's still, the study and the research still holds true today because we're seeing the same exact behaviors, and those behaviors repeat themselves during these market cycles. So, the other key finding was the average fixed income investor underperformed to a lesser degree. The average fixed income investor earned 2.63% less than the Bloomberg Barclays aggregate bond index gain. And the reason for that is because of the emotional decisions that ultimately hurt returns. Investors tend to sell out of investments during downturns and miss out on the rebounds. And the report here illustrates the importance of a long term investment strategy. The other finding was that retention rates increased. The average equity fund investor held on to equity funds for a longer period in 2023 compared to 2022. So I have another paper here I'm going to share. It has a nice chart to kind of illustrate what this research is indicating here. So while I'm doing that, just bear with me. Let me get that
Yeah,
pulled
just
up
to
here.
kind of summarize what you were sharing there while you're pulling that up, it's a behavioral bias, right? So what we're finding is that investors are panicking, or they're going into a panic mode, and they're selling during the downturn and then buying back when the market feels safe. Again, we're making an emotional decision with this, which is almost always after a recovery. So it's really the opposite concept of buy low and sell high.
Yeah, see what happens is when you try to time the market by selling when it's falling with the notion that you'll get it back when it rises again, you'll likely miss the best days of the market. And because the market turns so quickly, what happens is that when looking back over a 20-year period, in this case, from January 1 of 2004 to December 29th of 2023, six
Scroll
of
up
the
a little
seven,
bit if you don't mind.
scroll up,
I'm sorry, down. There, you're good right there. Okay.
um, 6 of the 7 best days occurred after the worst days, and 7 of the best 10 days fell within 2 weeks of the 10 worst days within that 2 decade period. That's pretty interesting stuff there. And so, what happens if you sell and miss those best days? Your return potential can fall dramatically. That's really ultimately what happens.